Hi, hello again. In this short session, let's have a look at what is a testamentary trust. Right. Okay. Quick introduction about myself again. CPA, tax agent, founding member of SEPEPA. Also two master degrees, one in accounting, one in financial planning, and I'm also a certified zero advisor. Before we go to the main content, just want to reiterate, okay, this session is only for general information only. So before you make any decisions, please contact experienced tax agent, financial planner, solicitor, or one of our wealth planners. All right, let's have a look. So a testamentary trust is commonly used during estate planning process to protect the assets of the family from creditors, family law actions, and at the same time provide flexibility in relation to the distribution of the estate. All right, that's the very good definition of testamentary trust. All right, and then so when and or how a testamentary trust is created. So the terms and conditions of the trust, including the appointable income or capital beneficiaries, trustee, and so on, they are to be designated in the will of the deceased. So it's actually at the time, so only after the deceased is passed away, then the testamentary trust will come to existence. Yeah, so it happened before. I remember someone come to us to say, "Oh, can you set up a testamentary trust for me?" So, so a testamentary trust actually doesn't come into existence until the person is deceased. Okay, is passed away. So it can be included in the will. So after the person pass away, then we can help you to set up the testamentary trust. All right. So what are the benefits of a testamentary trust? So first of all, control is held by the appointor and trustee. So that's actually similar to a common discretionary trust or family trust. Okay. Generally speaking, it requires the trustee to look after family members in a specified way, rather than provide the trustee with complete discretion. So that's actually one major difference. Okay, one of the major differences between testamentary trust and common family trust. Yeah, so in a typical scenario, let's say for an example, in a testamentary trust situation, one of the beneficiaries, maybe one child, would suffer from addiction of drug or alcohol. Then the parents, when they pass down the assets in their will, uh, or when they prepare the documents, they can specify, okay, for this particular child, he can only receive like a fixed amount of income every week, okay, or every month, say $500 per week, something like that, so that the person can't receive a lump sum payment. Okay, so it could go into quite a lot of details, okay, on how the income can be distributed to each individual beneficiary. All right. And then depend on the terms of the trust deed, trustee may choose different beneficiaries to receive property income, capital gain, or dividend. So they can actually pick and choose different beneficiaries. So potentially, say for an example, in 1 year, if the trust deed allows, they can choose one beneficiary to receive all property income, and then another beneficiary to receive all capital gain, then a different beneficiary to receive all dividend. Okay, and so that's one of the benefits. It's actually quite flexible. Okay, provided if it's allowed by the trust deed. Okay, then capital gains tax of 50% on assets held for more than 12 months. That's still applicable for testamentary trust. This is similar to a common family trust or discretionary trust. And assets are protected from creditors. This is similar to common family trust as well, because no beneficiaries are direct owners of the assets, okay, in the trust. And then of course other considerations, yeah, you need to be careful what's going to be the share of the person, who's going to be the appointor, who's going to be the shareholders of the corporate trustee, if there's a corporate trustee. So that could be all the potential considerations for a better asset protection as well. Okay, so but it's definitely provide a better level of protection than individual ownership. Okay, then under a testamentary trust, minor beneficiaries are taxed like any ordinary taxpayer. Okay, this is another major difference between a testamentary trust and a common family trust. Okay, if you remember in one of our past sessions, in a family trust, a child under 18 years old can only receive a tax-free income of $416 a year. So anything above that will be penalized, okay, especially high tax. All right, and then, but in a testamentary trust, a beneficiary, even if a child under 18 years old, they can be treated as a common taxpayer. That means they do have that initial, $18,200 tax-free threshold. Okay, that's one of the major differences between testamentary trust and a common family trust. And then also it's offering some protections in sheltering assets from family court during divorce and family breakups. Yeah, as mentioned earlier, similar to a family trust. Yeah, this testamentary trust or any trust structure potentially will provide more protection, yeah, in family court situation, during divorce or family breakups. But still, it's getting more difficult. Yeah, but it's still providing very good protection. All right. And then what are the drawbacks or disadvantages of a testamentary trust? First thing is it's very complicated. Yeah. And then because of the complication, the cost could be really high to manage or operate a testamentary trust. Okay, that's both from the legal side and accounting side. Okay, and then sometimes, as mentioned earlier, maybe our parents want to add more specific requirements on how their children can receive the income from the testamentary trust. And then that means the more detailed requirement they need, the more drafting or the more adjustment or change the solicitors need to add to the legal document. Yeah. So what we do, we actually use Lightyear Docs, and then the legal firm, Abbott Morley lawyers, they're actually in the background. Yeah. So for any of our clients who need legal support, we just refer you to them. But when you are considering the detailed requirement, yeah, if you're going to change from their standard documents a lot, and then that's going to make the final version of the trust deed very complicated. Okay, so then of course it's going to be quite costly and potentially hard to implement as well. All right, and then also similar to a family trust, that if any profit is left inside the trust, the tax rate is going to be the top marginal tax rate of 47%. Okay, and then also, of course, similar to family trust, if an individual beneficiary's income is already quite high, and then potentially the tax rate the beneficiary's hands could reach 47% as well. Okay, so that's the drawbacks. All right, that's everything. And here is our contact details. So if you have any questions, let us know. Thank you, and see you in the next session.